All right, so let me get this straight. My net worth, my wife and I, is $50 million. We already have an AB revocable trust in play that's going to protect roughly, we'll call it $30 million. So if my wife and I died tomorrow, we're going to have about $20 million of our estate that is exposed. 20 million at 40%, about $8 million of tax would be owed in 9 months. I don't want to pay that tax. So I've got two choices. One is I could have that 20 million just go outright to charity, and that would avoid the tax altogether. But who's going to be ticked off in that situation if 20 million goes to charity?
The kids are going to be a little bit
Yeah, they're going to be
ticked off.
sitting like this during the conference and like, Dad, I don't like that concept, because they'd rather pay the 8 million of tax and get 12 million than have 20 million go straight to charity. So that's one option, 20 million. The kids aren't happy with that one. What's the other option of how the washing machine would work rather than just give it straight to charity?
So the washing machine works, we put that $20 million into a separate account, and over this 15-year period, we pay out $20 million to charity. And a lot of times that's to a client's private foundation or to a donor-advised fund. So it's probably a charity that the client family still controls. But over 15 years, the charity receives $20 million plus IRS interest rate. And IRS publishes an interest rate every month, but it's generally pretty low. And so we pay the $20 million plus interest to the charity over 15 years. But in the meantime, the kids have the ability to invest and grow and build that 20 million beyond what they're paying to charity. And whatever's left over after paying charity, the 20 million plus interest, comes back to the kids tax-free. We don't have to write the check to the IRS, and it's essentially a second inheritance that they receive 15 years later.